Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at QXO.
If you find our talks useful, please consider subscribe, like, and comment underneath. Because today, we are looking at a wealth-building story that honestly, it completely defies traditional market logic.
It really does. It's wild.
Right, like imagine trying to fix a bicycle while you are actively riding it. But now imagine that bicycle is traveling at Mach 2.
Yeah.
And you are currently trying to strap a literal rocket engine to the back frame.
Exactly.
That is exactly what Brad Jacobs is doing with QXO right now.
Yeah.
We're talking about a transition from this, nascent, almost conceptual platform to an absolute industry juggernaut.
Yeah.
And doing it virtually overnight.
Basically, yeah.
So our mission for this analysis today is to break down exactly how this legendary 300x roll-up playbook is being applied to an $800 billion fragmented industry.
Right.
And crucially for you listening, we need to figure out if the recent 32% pullback in the stock is a value trap that you should avoid, or maybe a genuinely asymmetric entry point for your portfolio.
It is a phenomenal question. Because, when you see a company scale this rapidly, and we are talking about truly historic speed here.
Unprecedented, really.
Yeah, the market's natural instinct is just extreme skepticism. You have to look past the initial top-line shock value and really try to understand the underlying mechanics of this consolidation strategy. Because the wealth-building context here, it's all about execution. Can they actually integrate what they're buying? Or, are they just hoarding revenue to look big on paper?
Well, the shock value is definitely there. So let's start with the genesis of this Goliath, because the fundamental numbers here are they're staggering.
They are.
We are talking about revenue that exploded from just $57 million in 2024 to $6.8 billion last year.
Right. And a leap like that, that doesn't happen organically. You don't just sell that much more product in 12 months.
No, absolutely not.
It is entirely driven by aggressive strategic acquisitions. So to understand this, you really need to understand what a roll-up strategy actually is.
Oh.
It's basically when a company buys up a bunch of smaller companies in the exact same market and then merges them into one massive entity.
Right, to drive down costs.
Exactly, driving down costs and driving up efficiencies. So the primary engine for QXO's initial jump was the staggering $11 billion acquisition of Beacon Roofing Supply in early 2025.
Wow.
That single monumental move, that's what put them on the map.
But they didn't stop there, did they?
No, they did not.
Because they just closed a $2.25 billion acquisition of Kodiak Building Partners. Right. And that adds another $2.4 billion in revenue. Plus, it aggressively expands their addressable market to over $200 billion.
Because of the lumber?
Exactly. Because now they are combining lumber and structural products with their existing roofing business.
Okay, let's unpack this. Because going back to my, my bicycle and rocket engine analogy.
Yeah, the Mach 2 bicycle.
Right. This level of hypergrowth, it just sounds incredibly dangerous. How exactly does a company manage to reach an EBITDA run rate exceeding $1 billion in under 10 months without the wheels completely falling off?
It's crazy to think about.
It is. But actually, before you answer that, let's clarify what an EBITDA run rate even is for the listener, just so we're all on the same page.
Absolutely. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Okay.
It's essentially a measure of a company's raw operating profitability before all the accounting tricks and tax bills kick in.
The pure cash engine.
Right. And a run rate, that just means taking a recent snapshot of that profitability, say, from the last month or the last quarter, and projecting it out over a full 12 months.
So QXO is currently operating at a pace that suggests they will generate over $1 billion in raw profit this year alone.
Wow.
And what's fascinating here is that achieving this without the wheels falling off, as you said, that is classic Brad Jacobs.
Right, the CEO.
Yes. He is the architect behind some of the most successful industrial consolidations of the modern era. And his secret to keeping the wheels on is remarkably tight control.
Tight.
Well, he maintains an approximate 49% ownership stake in QXO.
Wait, 49%? Personally?
Roughly, yeah. And that ensures decisive execution and near-perfect alignment with common shareholders. He isn't just some hired CEO hoping for an end-of-year bonus, right?
Right, he's got skin in the game.
Massive skin in the game. His own wealth is fundamentally tied to the success of this roll-up.
Which definitely explains the aggressive posture. But let's be real here. When you move that fast and you're buying billion-dollar companies left and right, it gets pretty messy on the balance sheet.
Oh, it gets incredibly messy.
Yeah.
And you really have to look closely at the earnings trajectory to understand that mess, rather than just, reading the scary headlines.
Right.
For example, if you look at the fourth quarter of 2025, their GAAP earnings per share looked negative. It was minus 17 cents.
Okay, minus 17 cents. And GAAP, just to clarify, that's just the standard accounting rules.
Right.
Generally accepted accounting principles.
Correct. But those standard rules, they basically force companies to immediately deduct a lot of massive one-time fees when they buy another company.
Like what kind of fees?
Things like legal fees, severance packages for executives they're letting go, asset amortization.
Right.
So that negative 17 cents, that was entirely due to acquisition-related expenses.
It wasn't the core business failing.
Exactly. When you look at the adjusted EPS, which strips out all that one-time accounting noise to show you how the actual core business is performing day to day, it hit 2 cents.
Oh, wow.
Which was perfectly in line with Wall Street consensus. And on top of that, management has explicitly guided that the Kodiak deal will be highly accretive to 2026 earnings.
Okay, pause right there. Because Wall Street loves throwing around the word accretive.
They do.
What does that actually mean for the listener who might be holding the stock?
It essentially means this acquisition isn't just, adding sheer size for the sake of ego.
Yeah.
It's actively boosting the earnings per share right out of the gate.
Okay,
It basically pays for itself and then leaves extra profit for the existing shareholders.
that makes sense. So the underlying engine is actually running very smoothly, even to the regulatory paint job looks a little scorched from the rocket exhaust.
That's a great way to put it, yeah.
I see the vision. So now that we know how fast they are growing, we really need to understand why they chose this specific industry
Right.
and how they plan to defend this newly acquired territory. Because an $800 billion market, that is a colossal playground.
It is, and the defining characteristic of the U.S. building products distribution industry is extreme fragmentation.
Fragmentation meaning lots of little guys.
Exactly. You have over 20,000 small, subscale distributors out there.
Wow, 20,000.
Yeah. Picture like a local mom-and-pop lumber yard or a regional roofing supplier that has been operating out of the exact same dusty warehouse for 40 years.
Right, with a guy named Sal who just knows where everything is.
Exactly. Sal with his clipboards, whiteboards, and, legacy accounting software from 1995.
Right.
They fundamentally lack purchasing power with global manufacturers. Their logistics are wildly inefficient, and they are completely void of any modern data capabilities.
Which brings us to QXO's competitive moat. Because as they buy up these localized assets, these mom-and-pop shops, they aren't just changing the name on the building, are they?
No, not at all. Their entire strategy relies on scale and technological disruption. They are deploying AI-driven pricing, inventory optimization, and advanced logistics tools that those smaller peers, they simply cannot afford to build.
But how exactly does that translate to actual profit?
Yeah.
Like AI for roofing shingles.
Yeah, let's look at the mechanism, because it's brilliant. When a local roofer needs shingles, a mom-and-pop shop guesses the price based on maybe last week's invoice or just what they think the contractor will pay that day.
Just gut feeling.
Right. But QXO's AI, it looks at local weather patterns, regional supply chain hiccups, competitor inventory levels, all to dynamically price those shingles in real time.
Wow, like airline tickets.
It's exactly like airline tickets. And that algorithm alone recovers millions in what the industry calls margin leakage.
Okay, I see.
And then you optimize the truck routes. If a delivery truck leaves a mom-and-pop warehouse half empty, that is burned fuel and wasted time. QXO's algorithms ensure every single truck is fully loaded and taking the most fuel-efficient route possible. This digital enablement totally strengthens the workflows for the customers, the contractors, and builders, which creates incredibly high switching costs.
Here's where it gets really interesting, though, because you mentioned the builders and the contractors.
Yeah.
But wait, isn't the housing market incredibly sensitive right now? We just saw mortgage rates hit a 7-month high.
We did.
Home builder stocks have been taking a beating because new home construction is slowing down. Isn't this a remarkably risky macroeconomic environment to be consolidating building supplies?
It's a highly logical concern. And honestly, it's exactly why the market sometimes misprices this asset.
How so?
Because you are looking at new construction, right, which is highly cyclical and totally dependent on interest rates.
Right.
But QXO has deliberately built a macroeconomic shield against that. Approximately 80% of Beacon sales are non-discretionary repair and remodel revenue.
Repair and remodel.
Yeah, we call it R&R.
So they aren't relying on people building brand new housing subdivisions.
Precisely. You have to remember the average age of a home in the United States is currently 42 years old.
Oh, wow. 42 years.
Yeah. And aging infrastructure means the demand for R&R is incredibly sticky. Think about the underlying logic here. If your roof leaks, you have to fix it.
Right.
It is entirely non-discretionary. You aren't going to, pull up the Federal Reserve's latest dot plot on mortgage rates before you call a roofer to stop water from pouring into your living room.
Right. You just need a bucket and a guy with some shingles.
Exactly. The repair has to happen regardless of what the macro environment is doing.
That structural reality really does insulate them from those cyclical downturns. It provides a very reliable baseline of recurring cash flow.
It really does.
But establishing that baseline, building the AI infrastructure and buying up the market, well, that brings us to the very thing that crashed the stock.
Yeah.
We need to transition to the elephant in the room, the balance sheet, and the dilution trap narrative.
This is huge. It raises an important question about risk assessment that, every investor needs to fully grasp.
Right.
QXO's balance sheet reflects a very aggressive growth at all costs posture because to fund these multi-billion-dollar deals, they couldn't just use the cash in the register.
No.
They had to issue a tremendous amount of new equity.
Let's look at those numbers, because they are heavy.
Yeah.
In January 2026, they completed an unprecedented capital raise. They priced 31.6 million shares at $23.80 each.
Right.
And that generated roughly $3 billion in cash. Then, to pull off the Kodiak deal, they funded it with $2 billion in cash, plus another 13.2 million shares of equity.
Exactly.
Now, for common shareholders, this level of equity issuance, it feels exactly like someone pouring a gallon of water into their bowl of soup.
That's a great analogy.
Right. Sure, you have more volume in the bowl, but the actual flavor, your proportional ownership of the company's value, it is severely watered down.
Yeah, completely diluted.
And the market reaction was swift and brutal, wasn't it?
It was. After soaring to a 52-week high of $27.14 on the initial Kodiak announcement, the shares plunged 18.9% in March.
Almost 19% in a month.
Yeah. The market was suddenly forced to digest this immediate equity dilution alongside the very real integration risks of swallowing yet another giant company so quickly.
It's no wonder this stock is currently trading roughly 32% off its peak, just kind of oscillating in this $19 to $22 range.
Right.
So I have to ask, is the market right to panic about this dilution trap? And what about the terms of the Kodiak deal? Because I read they secured a $40 per share repurchase option on that equity component.
That is the crucial detail right there. QXO has the contractual right to buy back those 13.2 million shares at $40 a share.
Okay, stop. That makes no sense to me.
How so?
Wait, they just diluted the stock heavily at $23.80 a share? And now you're telling me their master plan is to buy back the Kodiak equity at $40?
Yes.
That sounds like buying high and selling low. How on earth does that benefit the common shareholder?
If we connect this to the bigger picture, you have to look at the time value of money and the cost of capital.
Okay.
Right now, QXO needs cash to aggressively consolidate the market. By issuing shares for the acquisition, they conserve $2 billion in hard cash today.
Right. Cash they can use for other things.
Exactly.
Yeah.
Now, if the combined platform generates the massive free cash flow they expect over the next few years, the stock price should naturally rise well above $40.
Okay, I'm following.
So when they exercise that option, they essentially cap Kodiak's upside and permanently retire those shares, which offsets the initial dilution.
Ah.
It is a contractual pathway to ensure that once the heavy lifting of the integration is done, the long-term earnings power isn't permanently watered down.
Ah, I see. So it's about preserving cash flow today to capture market share with a built-in release valve for the share count later.
Exactly. And the fact that the stock has found a consolidation zone between, $19 and $22, that implies that a psychological floor is forming.
Meaning the selling has stopped.
Right. The sharp pullback has essentially reset the momentum. It washed out the short-term speculators who were just playing the initial pop of the acquisition announcements.
The fast money.
Yeah, the fast money. And it's establishing a new base composed of investors who actually understand the long-term cash flow mechanics. The dilution risk is real, but it is arguably already priced into that deep 18.9% drop.
Okay, so what does this all mean for the immediate future? How are the massive institutional investors positioning themselves? And what are the specific triggers that will drive the stock in the next 3 months?
Well, institutional conviction actually remains very firm, despite all the volatility we saw in the first quarter. Yeah. At the end of Q4 2025, 63 hedge funds held QXO. This is only up a very slight dip from 65 in the prior quarter.
Okay.
Which tells you that the smart money isn't panicking about the watered-down soup. They understand that the overall size of the bowl is expanding faster than the water being poured in.
That makes sense. We also saw Marvista highlight QXO as a top holding in their Q1 2026 U.S. Quality Strategy letter.
They did.
And they specifically emphasized the exact things we've discussed today: the company's data advantages and scale potential.
Exactly.
Plus, RBC Capital maintains an outperform rating. I know they lowered their price target slightly to $28, but from the mid-April trading range, that still suggests over 25% upside.
It does. But the most telling data point actually comes from analyzing the momentum in macro flows.
Okay.
Look at what happened on April 8th, 2026. Shares soared as much as 12% intraday, eventually closing up 8.9% on unusually high volume.
And the price action was directly tied to the U.S.-Iran ceasefire, right?
Yeah.
Because that triggered a plunge in Treasury yields.
Exactly.
But I look at that and think, why on earth is a domestic U.S. building supply company reacting so violently to geopolitics in the Middle East? How should investors interpret this hyperreactivity to interest rates?
This requires peeling back a layer on how modern markets actually operate. This hyperreactivity indicates that the stock is heavily held by algorithmic momentum funds, and those funds use QXO as a proxy for housing and industrial cyclicals.
Meaning they don't look at the individual company, just the sector.
Right. So when the Middle East ceasefire eased global energy costs, inflation fears cooled rapidly.
Which drove Treasury yields down.
Exactly. And lower yields mean Wall Street anticipates lower mortgage rates down the line. Now, even though we just established that QXO is insulated by its sticky repair and remodel business.
Right, the leaky roofs.
Yeah, these momentum algorithms, they don't care about the nuance. They just buy it as a broad macro play on housing.
So the algorithms just see the words building materials and automatically buy when interest rates drop.
Precisely. And remember, the stock had a recent 30-day return of negative 13.67%.
Wow.
Meaning there were a lot of short sellers betting the price would continue to fall. So when that swiftly transitioned to a relief rally on April 8th due to the yields dropping, it triggered intense short covering.
Just to clarify for the listener, short covering is when investors who borrowed shares to bet against the company are suddenly forced to buy the shares back at market price to close their positions.
Right.
Which creates a tidal wave of buying pressure.
Correct. It artificially drives the price up further. So if macro conditions stabilize, there is still intense short covering potential trapped in this stock.
Okay. And what about the rumors of future M&A to hit their stated $50 billion revenue target? Because we know Jacobs walked away from buying GMS when Home Depot bid too high.
Yeah, that walk away, that is a crucial piece of the puzzle. It proves his discipline.
Right.
It proves he won't overpay just to grow the top line and look good for the press. But the market widely anticipates the next transformative deal is coming. And that brings us to the 3-month catalyst calendar.
Right. Let's lay out exactly what the listener should be watching for over the next 90 days to see if this wealth-building thesis holds up.
First and foremost, Q1 2026 earnings. This is the critical near-term catalyst.
Why is this one so important?
Because management promised the Kodiak deal would be highly accretive to 2026 earnings. Q1 is the very first full quarter they have to prove this out on the actual profit and loss statement.
Oh, okay.
We need to see hard evidence of synergy realization and margin improvement. The market simply won't accept another quarter of, just wait and see.
Secondly, we need to watch for potential strategic events, right? Like an investor day or a new M&A announcement.
Exactly.
Given the recent stock pullback, Jacobs might accelerate share repurchases to defend the stock price. Or maybe announce a smaller, localized tuck-in acquisition. That would signal to the market that the roll-up pipeline is still active and viable without requiring another massive round of equity dilution.
Absolutely. And finally, the macro watch.
Ah,
Interest rate dynamics. You really want to watch for a sustained drop in the 10-year Treasury yield below 4.3%.
4.3%.
Yeah. If that happens, it will act as a powerful sector rotation catalyst, basically pushing algorithmic money back into housing-related stocks like QXO, regardless of their actual internal fundamentals.
Okay, this has been an incredible breakdown of a highly complex situation. Let's bring this entire analysis together and deliver the final investment thesis.
Let's do it.
Based on everything we've looked at today, the historic revenue growth, the clear mechanics of the dilution overhang, the AI-driven digital moat, and the upcoming macro catalysts, we are giving this a bullish score of 8 out of 10.
I am in full agreement with that rating, but it is vital to note that the target horizon here is a multi-year hold, specifically 1 to 3 years.
Right.
This isn't a day trade for quick momentum. This is about participating in a structural shift in an $800 billion industry.
Exactly. It is a rare second mover advantage to invest alongside Brad Jacobs, who is, undeniably one of the most successful industrial consolidators of the modern era.
Definitely.
Despite the near-term gap losses and the equity dilution that have spooked the short-term momentum traders,
Yeah.
QXO has rapidly assembled a $1 billion plus EBITDA run rate and a nationwide distribution mode.
Yeah.
With the stock off 32% from its highs and macro interest rates potentially peaking, QXO presents a genuinely asymmetric entry point into a future category king. It is perfectly poised for significant margin expansion and multiple re-ratings.
Meaning Wall Street will eventually be willing to pay a higher premium for every dollar of profit they generate once the integration is proven. The wealth-building potential is glaringly clear, provided management executes on the gritty integration phase as flawlessly as they executed on the flashy acquisition phase.
Before we wrap up today, I want to leave you with a final, broader thought to ponder. We've talked extensively about the financial engineering, the multiples, and the algorithms today, but consider what the ultimate end game is for traditionally analog, local industries like lumber, structural products, and roofing. What happens to the broader economy and to the fabric of our local communities when the independent mom-and-pop distributor in your town is certainly forced to compete against Wall Street's algorithms and billions of dollars in AI-optimized logistics?
That's a huge question.
It's a fundamental shift that goes far beyond just one stock ticker.
It absolutely does. We are watching the relentless digitization of the physical world happening right in front of us.
Thank you so much for joining us for this analysis. We hope this gave you a clearer picture of the mechanics at play beneath the headlines. Until next time, stay curious and keep building.